Hello guys, welcome to our new video. In this video, we will discuss five companies operating in China and the potential risks and opportunities of investing in them. The five companies we cover today are Las Vegas Sands, Yum China, Estée Lauder, Nike, and AO Smith. China is an important market for these companies as it holds great promise for growth and profitability. However, the market also comes with challenges such as economic uncertainties, trade tensions, and the impact of the COVID-19 pandemic. This video, we will explore these risks and opportunities to help you as investors to make informed to take informed correct decisions. The first company we discuss on is Las Vegas Sands. Las Vegas Sands is a high risk opportunity in China's booming gaming industry. With its ownership of Marina Bay Sands in Singapore and a 69% stake in Sands China, LVS has a strong presence in the Asian gaming market. However, the pandemic resulted in a sharp decline in earnings from 5 billion US dollars on 2018 to only 260 million US dollars in 2022. Despite this, India is poised to benefit from China's recent lifting of restrictions and its status as one of selected few companies allowed to operate mega casinos in Macau. Investors should be aware that LVS shares come with substantial risks. The gaming industry is highly cyclical, and unexpected events like the pandemic can cause profits to plummet while the debt remains. In addition, building casinos is a costly business, putting additional strain on the company's financials. The shares have nearly doubled in the anticipation of China's reopening, but a stumble could have significant consequences. Therefore, LVS for me is unsuitable for investors who are faint of heart and looking for a safer investment option. The second stock in our list is Yum China. Recently, I saw a lot of financial gurus suggesting to invest in Yum China for a piece of China's growing restaurant market. Let's have a look into it. As the largest restaurant company in China with over 12,000 locations, Yum China holds exclusive rights to operate KFC, Pizza Hut, and Taco Bell. Yum China owns and operates all its stores, unlike its US counterpart, allowing it to keep all the profits during solid sales. Despite the challenges posed by the pandemic, Yum China has continued to grow sales and profits thanks to its digital and delivery investments they made recently. While its recent stock growth has been impressive, Yum China has risks, including a 32 times price to earning ratio and potential obstacles in China's reopening. Additionally, the company has been affected by food supply chain contamination and anti-Western sentimental in the past, making it a high-risk investment. For those willing to bet on China's growth in the restaurant industry. The third company is on the list is Estée Lauder. Estée Lauder is a leading player in the prestige beauty market, known for its premium products with a long growth history. China plays a crucial role in the company's success, contributing about a third of its sales and even more profit due to its higher margin profile. The company also benefits from travel retail as affluent Chinese travelers play a significant role in this segment, making up about a third of its total business. Estée Lauder has adapted well to the challenges posed by the pandemic. With a revamped online presence that offers consultations and other features, allowing it to weather the storm of department store closures. However, there are certain risks to consider here. Uh, a recession in the US or Europe would impact the demand for premium beauty products. The stock's current valuation is relatively high, trading at 42 times PE, which means that a lot of success has already been priced in. Nevertheless, Estée Lauder currently appears to be on a positive trajectory. Uh, okay, let's get into the next one. Now we come to the fourth stock, is none other than everyone's favorite, Nike. China is important to Nike for several reasons. Firstly, the country makes up about 15% of its total sales. And before COVID-19 pandemic, it was overgrowing, which helped to boost Nike's overall sales growth. Secondly, more than a third of Nike's merchandise is manufactured in China. And supply disruptions caused by the pandemic have affected the company's inventory and increased the costs. Uh, a smooth supply chain and increased online sales could lead to a more profitable Nike. However, there are risks associated with this situation as well. New supply disruptions could impact profit margins and sales growth. And the stock's current 34 times PE ratio is expensive actually. Additionally, a recession in the US or Europe could hold back demand for Nike's product. However, the supporters of the stock believe that these factors are only temporary and that Nike will be able to weather any challenges. Then we come to our today's last stock, which is A.O. Smith. A.O. Smith sells water heaters and water treatment devices for homes and businesses with the US as its home market. China used to make up 35% of its sales, but due to the slow Chinese economy and trade tensions, coupled with the impact of COVID-19, Chinese sales have to fallen to 20% of the total and continue to decline. The company's share price recently improved after hitting an all-time low valuation of 13 times PE. A rebound in demand in China could boost the stock's value. There is also the risk of a US housing market slowdown affecting US sales, but replacement demand for the water heaters could provide some cushion. A.O. Smith recently reported better profit margins from China in its fourth quarter results, which sent the stock almost 14% higher. So that's it about the five stocks. So let's conclude. In conclusion, investing in companies operating in China presents risks and opportunities. Investors should weigh the potential rewards against the potential challenges and do their due diligence before making an investment decision. Some companies discussed in this video, including Las Vegas Sands, Yum China, Estée Lauder, Nike, and A.O. Smith, each of which presents unique challenges and opportunities. Why? Some of these companies may be better suited for more risk-averse investors. Other may be a good fit for investors with a higher tolerance for risk. Ultimately, the decision to invest in any company, including those operating in China, should be based on a thorough understanding of the risks and rewards involved. So that's all from us for today. Thanks for watching. Hope you all got some valuable information from today's video. Don't forget to like and subscribe for more informative contents and leave a comment below with your thoughts on this topic. Also, if you have any queries or doubts, you can comment it down and I will try my best possible to answer your queries. I will see you with another video. Until then, bye bye.